The United States, a nation long regarded for its commanding influence over the global financial system, recently made a striking decision that could alter the trajectory of international financial markets. The U.S. government ordered two of its largest financial institutions, J.P. Morgan Chase and Bank of America, to withdraw from a Chinese initial public offering, IPO. Not in New York, as one might expect, but in Hong Kong. This move was subtle in its execution, but loud in its implications. It raised questions that would ripple through the global financial system, triggering both immediate and long-term consequences. But what happened next was perhaps more significant than the initial directive itself, and it is this unfolding sequence of events that could mark the beginning of a new financial era. China's response to the U.S. pressure was not one of confrontation. There were no press conferences, no angry speeches, no calls for retaliation or sanctions. The Chinese government didn't make public threats or grandiose statements. Instead, Beijing responded with remarkable silence, a silence that would, in the days to come, speak volumes. The world watched as China silently began to make strategic moves with its money, making clear that its response would be calculated, deliberate, and far-reaching. It wasn't just about one IPO or one financial transaction. What was unfolding was part of a much broader shift in the dynamics of global finance. At the heart of this shift was a seemingly innocuous IPO on the Hong Kong Stock Exchange. The company behind the IPO, contemporary Amperex Technology Company, Limited CATL, is a Chinese manufacturer of lithium-ion batteries for electric vehicles, EVs, and energy storage systems. The company is intricately tied to China's national goals for technological innovation and its ambitions to dominate the green energy and defense technology sectors. CATL's projected $5 billion listing attracted strong institutional demand, and underwriters from J.P. Morgan Chase and Bank of America, two of the most powerful financial institutions in the world, were involved in the deal. There was quiet optimism about the success of the IPO, and everything seemed to be progressing smoothly. But behind the scenes, a new chapter in the U.S.-China financial rivalry was about to unfold. On March 27, 2025, just days before the IPO was set to take place, the National Security Council, NSC, issued an urgent warning. In Washington's view, CATL was no ordinary battery manufacturer. Its lithium-ion batteries were seen as a key component for China's future energy needs, including powering its fleet of submarines. Furthermore, CATL was known to have close ties to Chinese state-run laboratories and strategic defense initiatives. Washington believed that allowing such a company to list with the help of American financial institutions would inadvertently fuel China's technological and military capabilities, something that the U.S. could not allow. With this in mind, the U.S. government acted swiftly. Within 48 hours, J.P. Morgan Chase and Bank of America were instructed to withdraw from the CATL IPO. The move sent shockwaves through the global financial community. CATL's valuation plunged by $210 million overnight. The immediate financial fallout was significant, but the broader message was even more profound. This was not just about one IPO. This was about the United States exerting its financial power beyond its borders, using economic influence as a tool of geopolitical strategy. The withdrawal of J.P. Morgan Chase and Bank of America from the CATL deal signaled something new in the realm of international finance. Analysts quickly coined a term for what had just occurred: extraterritorial capital deterrence. This new form of financial pressure allowed the United States to exercise control over not only its own financial markets, but also foreign markets where American financial institutions operated. It was a bold assertion of American dominance in global finance, one that saw capital markets being used as a weapon in geopolitical struggles. The message was clear. If financial institutions wanted to continue doing business in the United States, they would have to align themselves with Washington's political priorities. For some, this move was a necessary step to counter the growing technological and economic influence of China. It was framed as a form of strategic containment. Proponents of the move argued that China's rise as a technological superpower presented a clear and present danger to U.S. national security. By cutting off financial support for strategic companies like CATL, the United States was attempting to stifle China's technological ambitions, particularly in areas like electric vehicles and defense technologies. After all, lithium-ion batteries are not only critical for the automotive and energy industries, they are also an essential component of modern military technology. However, critics of the move warned that it came at a significant cost. By placing national security considerations at the center of financial decision-making, the U.S. was undermining the global competitiveness of its own financial institutions. The decision to involve financial institutions in geopolitical maneuvering raised serious questions about the predictability and stability of American financial norms. If Wall Street could no longer operate freely in global markets, what would become of its dominance in the world economy? How would foreign investors and institutions respond to the idea that political priorities could dictate the flow of capital? In addition, the intervention exposed a larger shift in the global financial landscape. Hong Kong, long regarded as a neutral financial hub that bridged the gap between East and West, was no longer seen as a neutral space. Over time, it had increasingly aligned itself with Beijing, and by interfering in the CATL IPO in Hong Kong, the U.S. effectively acknowledged that the rules of the game had changed. The old financial order, where market forces dictated the flow of capital, was being supplanted by a new reality in which geopolitical considerations played an ever larger role. This raised the question, was this a calculated and clever strike by Washington, or was it a sign that the United States was becoming desperate to maintain control over a rapidly changing global financial system? One thing was certain, the CATL IPO was no longer just an isolated financial event. It had become a symbolic moment, a point of no return. The U.S. intervention in the deal represented a line in the sand, one that would have far-reaching consequences for the future of global finance. As Beijing watched this unfolding drama, it made its move, but not in the way many expected. Rather than respond with angry rhetoric or retaliatory sanctions, China chose a more subtle approach. It responded with money. Quietly, with deliberate precision, China began to divest from U.S. financial assets. Within 72 hours of the withdrawal from the CATL IPO, Chinese state-owned banks and sovereign wealth funds began to offload U.S. Treasuries. This move was executed without fanfare, no headlines, and no public pronouncements. But the impact was significant. According to data from the Treasury International Capital, TIC system, China reduced its holdings of U.S. debt by $78.5 billion in the first quarter of 2025, the largest quarterly reduction since 2016. At the time of the CATL IPO debacle, China's total exposure to U.S. financial assets, including treasuries, agency bonds, corporate debt, and equities, was estimated at $1.67 trillion. By the end of the quarter, that number was in freefall. But this was not a reaction born of panic. It was a calculated, strategic exit. As analysts at Barclays noted, it was a diversification play cloaked in diplomacy. In essence, China was repositioning its financial assets to prepare for a future in which it no longer had to rely on the U.S. dollar. The U.S. Treasury market had long been the cornerstone of China's foreign exchange reserves. China had accumulated vast amounts of U.S. debt over the years as a means of stabilizing its own currency and maintaining favorable trade conditions. However, with the growing tensions between the two superpowers, China's leadership began to question the wisdom of holding such large amounts of U.S. debt. If Washington could use financial tools as a weapon, as evidenced by the CATL IPO incident, then perhaps it was time for Beijing to reduce its exposure to American assets. China's move away from U.S. Treasuries was not the only sign of its changing financial posture. According to reports from Bloomberg, Chinese institutions began to redirect their capital into non-dollar assets, including gold, infrastructure bonds issued by the BRICS nations, and UN-denominated debt. This diversification was a clear sign that China was looking to reduce its dependence on the U.S. dollar and position itself as a leading player in the emerging multipolar financial system. In March 2025, the Shanghai Gold Exchange saw a surge in physical gold purchases, hitting a 5-year volume high. This was no coincidence. As geopolitical tensions between the U.S. and China escalated, Beijing's interest in accumulating gold and other non-dollar assets grew. China's push to secure more gold was seen as part of a broader strategy to hedge against potential financial instability and to build a reserve that would allow it to operate more independently of the U.S.-dominated global financial system. This shift in China's financial strategy is not an isolated event. It is part of a larger global trend in which nations are looking for ways to reduce their reliance on the US dollar and the US financial system. The rise of digital currencies, the expansion of China's Belt and Road Initiative, BRI, and the growing influence of the BRICS nations in global finance all point to a changing world order. In this new world, the US no longer has a monopoly on the tools of financial power, and the global financial system is becoming increasingly multipolar. In conclusion, the events surrounding the CATL IPO and the subsequent financial moves by China are not merely a case of a trade dispute or diplomatic tension. They are part of a much larger shift in the global financial system, one that is quietly but dramatically altering the balance of power. The United States, in its attempt to exert financial pressure on China, may have inadvertently triggered a chain of events that could reshape the global economy in ways that are only beginning to be understood. What is clear is that this quiet war, waged with money and not words, has the potential to change the course of history. As we continue to watch the unfolding developments, it is essential to recognize the profound implications of these financial moves. The global financial system is no longer what it once was. The rules of the game are changing, and it remains to be seen whether the United States can maintain its dominance or whether a new, multipolar financial world will emerge. What we do know is that the CATL IPO was just the beginning, and the world will be watching closely as the next chapter of this financial conflict is written.